Hey, it's Tom here and welcome back to the channel. In this video, we're going to talk about Berkshire Hathaway and more specifically what happens to Berkshire Hathaway stock after Warren Buffett is no longer at the helm. Of course, Berkshire Hathaway has been one of the most successful investments ever. Had you bought those shares in 1965, you would have paid about $7.50 a share. Those same shares are now worth well over 300,000 US dollars. So that's how you become one of the richest people in the world. That's exactly what Warren Buffett bought and held on to over that entire period of time, and of course making great investments within Berkshire Hathaway through that entire period. But it's been spectacular, and the real question is, Warren Buffett is into his 90s now. He's still at the helm. His business partner Charlie Munger is in his late 90s. So what happens when these people are no longer running the business? Is the stock just going to crash? Is the business going to die? This is something I actually wrote an article on for Hatch about a year or so ago. So it's a topic I want to revisit, kind of go through basically like a Philtown 4M analysis, look at what the business does or the meaning of the business, the moat or any competitive advantages they have, the management, which of course is going to be a key topic of this video, so both current management and potential future management, and then also margin of safety and looking at the current price of the business. So with all that said, let's get straight into the video and I hope you enjoy. And throughout this video, I am actually going to be referencing an article that I actually wrote myself back last year, which will be linked down in the description, and that basically summarizes a lot of the things that we're going to talk about in this video, but I'm going to give you sort of an updated version in this YouTube video. So firstly, let's talk about the basic business model at Berkshire Hathaway. Now, the business model is interesting because Berkshire Hathaway is not just one sort of company with one business. It is actually sort of a holding company of sorts with a massive number of underlying subsidiaries, underlying companies, and also investments in public companies. So Berkshire Hathaway owns about 90 businesses outright, and they also have an enormous stock market portfolio, which is obviously the part of the business that gets a lot of media attention. But at its core, Berkshire Hathaway really has the goal of growing the intrinsic value of the business, of growing the earnings power of the business in a couple of key ways. So basically what they do is they go out and they acquire businesses that generate a lot of cash, that are really profitable and are likely to be really profitable for a long period of time. And essentially with that cash that these businesses produce, that gets sort of sent to Omaha, sent to Warren Buffett to then reallocate into buying more businesses that produce more cash that gets sent to Omaha, and they can kind of just run this flywheel round and round and round, and continue to buy more businesses, produce more cash, buy more businesses, produce more cash, and they sort of just let the power of compounding do its thing. And that's how they've been able to grow from a pretty small business back in 1965 to an absolute mammoth business in 2021. In fact, they are the business with the most property, plant, and equipment on the planet. That is something that was written about by Warren Buffett in his latest annual letter. So they're a huge business now, and that's basically the core business model. So they've spread across many different industries throughout that period of time as they've continued to buy different businesses. But fundamentally, that is really what Berkshire is trying to do, is to continue to sort of roll the snowball down the hill. I don't know what other analogies I can really give here. Try to keep compounding the equity of their shareholders. So although there are a huge number of businesses under the hood at Berkshire Hathaway, there's really sort of three key segments that we can kind of break this down into. So firstly, there's all of the insurance companies. This has been a massive part of Berkshire Hathaway for a long period of time. There is then what you'd call the non-insurance subsidiaries, so all of the other businesses that they own that are not insurance, and there's sort of a couple of core parts of that as well. And then there are, of course, the public holdings. So let's go through insurance first. Basically, Berkshire Hathaway owns several insurance businesses, and insurance can be an okay business. It's really not a great business in the hands of most people. Basically, insurance is a commodity to a large extent. So people, when they go out and try and find an insurance policy that suits them, really they're often looking to buy simply on price. Now, Berkshire Hathaway actually has a couple of businesses that have pretty big price advantages. Geico probably being the most well-known example in that case. For a lot of people, they are going to be the lowest cost option to get auto insurance in the case of Geico. And the other thing with insurance is that it can be an industry where things can get crazy from time to time. when you're running an insurance company, basically what you're doing is you're collecting money in exchange for a promise that you will pay out some money if something should go wrong with whatever you're insuring, a few years out from today. So if you're Geico and you insure a car, you get paid some money up front for that promise that if someone crashes that car, you will pay out in future. So that sort of business model can attract a lot of charlatans. These people can collect a lot of money up front if they, undercut all their competition, but, a year, 2 years, 3 years down the track, they can suddenly be losing a lot of money if they didn't charge an appropriate price when they first made that deal. So from time to time, the prices just are not intelligent for Berkshire Hathaway to do kind of smart business. But over time, they've managed to sort of scale back and scale back up as it made sense to do so. And it's built up something called float. Now, float is basically the money that your insurance company is holding on to when you've paid your premium and you haven't yet claimed on that policy. And Berkshire Hathaway are basically able to go out and invest that float. So they've got essentially borrowed money that they are getting for free, and they're actually getting paid to hold on to in some cases if they make a small profit on their insurance businesses. And that's really been sort of pouring fuel on the fire of the compounding for Warren Buffett. He's able to take other people's money invested at like 20% a year over the last 60 years and really grow the equity of the shareholders in Berkshire a lot faster than he would have otherwise been able to. Now, for the non-insurance subsidiaries, there are a huge number of companies here, so I've just picked out a couple of them, and again, these are the couple that I wrote about in this article last year. And really, these are big, massive core components of what Berkshire does. So the first one is Burlington Northern Santa Fe. This is a railroad that was initially a public company, and actually I think Phil Town was an investor in for some time as well. But basically what happened is that Berkshire Hathaway acquired that company outright. So they took it off the public markets and it now belongs within the Berkshire Hathaway sort of overall entity. And Burlington Northern is, again, a business with a lot of competitive advantages that produces a lot of cash flow. And basically the way that they do that is they offer very low cost transportation. So if you're a business or an individual that wants to transport something in bulk, if you're trying to move tons and tons and tons of material literally across the country, then rail is almost certainly going to be the cheapest option. So it's going to be much cheaper than trucking and any other alternatives really to rail. So that is a big competitive advantage for Burlington Northern Santa Fe. The other thing is that a railway network that's been built over decades and decades and even centuries in some cases, something that is really basically impossible and super expensive to replicate. So that, of course, again, gives Berkshire a huge competitive advantage. There's almost certainly not going to be any sort of railway competitor that comes in, lays down some new tracks, and then kind of competes against Burlington Northern there. In a position where they essentially have a license to just print money until we get some other more economical kind of form of transportation, which, could come with electric trucks like Tesla are talking about and so on. But for right now, the rail business is extremely profitable. The other example I'll give of a wholly owned subsidiary is Berkshire Hathaway Energy. Now, Berkshire Hathaway Energy is a massive business sort of in its own right. There's actually quite a few companies that fall within that, and that is a business that's managed by a guy by the name of Greg Abel, who was actually sitting on stage with Warren Buffett at last year's annual shareholder meeting, which was very cool to kind of see some insights from Greg in that case. Now, Berkshire Hathaway Energy, as the name suggests, is an energy business, and they actually have some quite unique characteristics. So with many parts of that particular business of producing electricity, it's actually not a particularly profitable enterprise. So one of the things that you have to quite a significant extent with some of the businesses within Berkshire Hathaway Energy is that you actually have some government assistance, some government support. So they've got programs set up to where basically the investors in that industry, in this case Berkshire Hathaway Energy, are actually entitled to make a reasonable rate of return, in many cases around 10% per year. And if they can't make the numbers make sense to get to that 10% per year, there is some government programs in order to kind of make that happen. So that is a really attractive business. If you can earn 10% a year near on guaranteed, because this is a utility business, it's a must-have product for everyday people. If you can earn 10% a year like clockwork with next to no risk to a large extent, And we're in a world where interest rates are worth like 1, 2, 3% per year if you're investing in government bonds or something. That 10% a year business with next to no risk is a really valuable part of Berkshire Hathaway. And then, of course, you have all of the public holdings for Berkshire Hathaway. That's something I cover every quarter on the channel, going through the holdings that exist in that portfolio. So won't spend too much time on it in this particular video, but I will put up a screenshot here to show you the current largest holdings that sit in the Berkshire Hathaway public stock portfolio. So that's sort of our first two M's. We have meaning, which is all the business segments within Berkshire Hathaway, and we have the moat, which we sort of mentioned a few competitive advantages for some of those companies there. The next thing, and the big one, is management. Now, of course, right now we have Warren Buffett at the helm. He sort of drives many of the capital allocation decisions, certainly the very large ones with investing in new stocks or acquiring new companies. But we really need to look at what the future management is going to be like for Berkshire Hathaway, at least in my opinion. Now, there's sort of a couple of things to understand here and unwrap. So the first thing we need to understand is what Warren Buffett actually does at Berkshire Hathaway. Now, many of you may be surprised to know that Warren Buffett basically actually does nothing when it comes to sort of many of the everyday operations of the individual subsidiaries within Berkshire. So each of the subsidiary companies, whether that's Burlington Northern Santa Fe, or whether that's Berkshire Hathaway Energy, or See's Candy, or Nebraska Furniture Mart, or Acme Brick, or any other company that Berkshire owns, they all have their own management teams. So Warren Buffett really is not operating those businesses every day, and therefore when Warren Buffett is no longer at the helm, really nothing will change with how those businesses operate. They will still have their own management teams. They will still send the profits to Omaha to be reallocated. But that's really the bit that will change, is that reallocation of capital. So that is really Warren Buffett's prime focus right now and has been for decades. So we really have to understand who is going to be reallocating that cash, because that's really the only big factor that will change at Berkshire. And I don't want to understate how big a factor that, of course, is for the future returns for Berkshire shareholders. Now, in my opinion, there's sort of going to be two sides of the management moving forward. Firstly, there's going to be the subsidiary businesses that we just talked about. And I think probably the prime candidate for which the managers of all the subsidiaries may report to if they need to is probably Greg Abel at Berkshire Hathaway Energy at this point. And he's now the executive chairman, I think is his title, of non-insurance subsidiaries. I'll put that exact title up on the screen here, but nonetheless, he was at the Berkshire Hathaway annual meeting last year, up on stage with Buffett, and I'm going to take that as a pretty big hint that that is, Greg Abel being sort of first in line to take on that position. And he already actually manages a lot of the internal capital allocation decisions at Berkshire. So if Berkshire Hathaway Energy needs to spend money on some project, he actually makes a lot of the decisions on whether that's going to be an attractive return for Berkshire and so on. So Greg Abel is probably up there as my sort of prime candidate for one of the future components of management. The other side of management is investing in public stocks and reallocating capital outside of Berkshire's existing businesses. And I think the prime candidates there are Ted and Todd. So if you're not familiar, Berkshire Hathaway currently has two portfolio managers other than Warren Buffett, and that is Todd Combs and Ted Weschler. Now, they are both phenomenal investors in their own right. Ted Weschler especially had a phenomenal track record leading into his time at Berkshire Hathaway. Todd Combs is a little bit trickier to find sort of performance reporting for, but nonetheless, they are both sort of the prime candidates to be managing money for Berkshire moving forward. And we've seen some interesting positions kind of pop up in recent 13F filings over the last year or so for Berkshire. We've seen investments in things like Amazon and things like Snowflake, and it's pretty interesting to see those guys start to invest in businesses that perhaps Warren Buffett would, but nonetheless, Buffett is still confident that both of those people are sort of intelligent investors, are value investors. Like Charlie Munger might describe it, all intelligent investing is value investing. So even though they have a sort of different circle of competence and will invest in different businesses than Warren Buffett might, they're still applying that same core philosophy of trying to buy something for less than it's worth and trying to get a lot of intrinsic value for every dollar that you're actually paying in price. So finally, let's look at our fourth M, which is margin of safety. So no business is worth an infinite price. If we acquire a great business, we can turn that into a poor investment if we overpay. So let's look at what the price is currently doing for Berkshire Hathaway. Now, traditionally, there's been sort of a couple of ways that Berkshire Hathaway has been valued. So Warren Buffett himself has traditionally used a simple price to book multiple to try and get a rough feel for intrinsic value for Berkshire Hathaway and where the business is currently trading at. Now, traditionally, that metric has been about 1.2 times book value. That is actually the price at which Berkshire was allowed to buy back shares if they so desired, was anything below 1.2 times book value. That has actually recently moved up to 1.3 times book value, and they have actually been buying back quite a few shares in the past few months. So I'm going to interpret that as anything below 1.2 times book value certainly is probably below intrinsic value for Berkshire, and even probably anything below 1.3 times book value is probably below intrinsic value. If you're wondering why Berkshire gets sort of that premium to book value, basically it's because of this. When you acquire a business at Berkshire that goes on the balance sheet at 1 times book value, you have that on the balance sheet as an asset. But over time, many of these businesses have become much more valuable. So Geico is a fantastic example. That business is probably about 3 times as valuable as it was in the late 90s when it sort of was first fully acquired. But that still sits on the balance sheet at 1 times book value. It's never been sort of re-rated up to a higher valuation. So therefore, you have to put it sort of a premium on that purchase price from back in the 90s, which is how it's still sort of accounted for on the books at Berkshire. Now, the other bit of valuation work I'm going to share with you is actually from a guy by the name of Chris Bloomstran. Now, Chris Bloomstran probably spends more time analyzing Berkshire Hathaway than Warren Buffett does. And each year he writes a very long, very detailed letter to his own investors because he does run a fund. And a big part of that every year is valuing Berkshire Hathaway because it's a big sort of component in the fund. So I'm going to put up a screenshot here of the latest intrinsic value calculation from Mr. Chris Bloomstran, and basically it comes up with a few different sort of approaches to this. So we have a sum of the parts basis, which comes out at about in B share terms $325, gap adjusted financials $348, a simple price to gap book value of $339, a two-pronged approach, which is what sort of they tend to use, of $365, and a simple average of all of those different approaches of $344 per B share. And no matter which one of those figures you use, they are actually all substantially higher than the current stock price, which I will put up on the screen here, which is about $260 per share. So Chris Bloomstran is definitely a bit more optimistic about the intrinsic value of the business than that 1.2 or 1.3 times book. Currently, the stock is trading north of 1.3 times book value. I think both of these approaches are probably valid. I think there's almost no way that Berkshire is worth less than 1.3 times book value, but it could certainly be worth a lot more, which is sort of the approach that Chris Bloomstran has taken here. And if you want to read more about the methodology for Chris Bloomstran's intrinsic value approach, I will leave his letter linked down in the description below if you're interested in checking that out. It's really well written. I haven't read the full letter because it's like 100 pages long, but nonetheless, you can go in and check out the Berkshire specific sections if you like. So that's it from me today. I guess in terms of trying to sum this whole thing up, I really don't think that Berkshire Hathaway stock is going to crash like crazy once Warren Buffett does unfortunately pass away. I think the culture of Berkshire Hathaway will persist for a long time. I think many of the businesses at Berkshire Hathaway will persist for an extremely long time. And I think that in terms of management, the business is going to be in very, very good hands. So that's it from me today. I do hope you enjoyed the video. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.